Good morning, everyone. I would like to welcome my listeners and viewers in the United States and all around the world. I am Vince Rocco, and it is Tuesday here in New York City, so let's go behind the headlines and get the real story. But first, this is Talking New York Real Estate, the state of our industry. And up front today, last week, on September 18th, the Fed Reserve, as planned, implemented a surprising interest rate drop, signaling a shift in its monetary policy. The 50 basis point cut, the first in 4 years and the largest rate cut since 2008, came in response to slower than expected economic growth and weakening labor market conditions, despite previous efforts to control inflation. While inflation has moderated and is moving sustainably towards 2%, concerns about a potential economic slowdown have led the Fed to act preemptively, but the judges agree that the risks to achieving employment and inflation goals are roughly in balance. The rate drop is expected to lower borrowing costs for consumers and businesses, potentially boosting sectors like housing and auto sales. However, it also raises questions about the Fed's long-term strategy and whether this move will be enough to sustain economic momentum heading into 2025. We have our chief economist here at the table this morning, and he will break it all down for us. We will discuss, and we will have all that and so much more as Talking New York Real Estate gets underway on this very busy Tuesday morning. And in the news this morning, the stock market last week finished above 42,000 for the first time in history after the Fed's big rate cut the day before. Stocks were ripping higher last week, putting the Dow Jones Industrial Average up 620 points or 1.5%, on pace for a record close at about 42,000. The S&P 500 was 2% higher at 5727, heading for its own record finish, and the NASDAQ Composite Index surged 2.9% to 18,080. And from the desk of our chief economist, the average 30-year mortgage rate fell to 6.9% last week, down from 6.2% the week before, reading the lowest since February of last year. Mortgage rates have been steadily declining since the beginning of May, falling 1.13% during that time. And with inflation expected to continue declining in the current months, we believe mortgage rates will follow, but home sales have been slow the past few months, with existing sales down 2.5% in August. Rising inventories combined with falling rates should lead to a pickup in the activity in the coming months, although some buyers may try to wait for rates to fall further before they make a move, but that could backfire if other buyers start buying now, which would reduce inventory and put upward pressure on prices. And converted industrial spaces often lack the warmth of other types of pre-war properties, but a fourth-floor loft at 176 Duane Street asking $5.6 million is wrapped in warm wood and natural brick with wood-burning fireplace and burnished wood floors. Built in the 1800s and used as a spice and coffee grinding factory, the Neo-Grec building in the Tribeca West Historic District, just across from Duane Park, was converted to lofts in 1999. I remember that. The two-bedroom loft doesn't sacrifice warmth for loft luxuries or open spaces and soaring ceilings. That's my kind of place. Douglas Elliman has the listing. And finally, Miles Ducey McBride, the New York Knicks rising star, is flexing both on and off the courts, locking down a swanky unit at West Chelsea's One Highline for $15,500 per month. This according to the New York Post. His new digs, spanning 1,600 square feet, come fully furnished with high-end pieces that scream luxury. The unit, located in a sleekly designed development building, boasts sweeping city views thanks to its prime perch overlooking the High Line. And as always, I say fabulousness and folly. And with me at the table today are David Rodriguez from Loan Depot, Stephen Gottlieb from Coldwell Banker Warburg, and the aforementioned and host of the popular podcast Crossing the Line, and my friend Greg Heym, who is chief economist here at Brown Harris Stevens.
Hey, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you hear a lot about how crucial it is to have the right partners in this industry. At Roadway, we don't just move your clients, we give them an experience they'll love. Specialized services to our white glove treatment, it's all about making sure your clients feel taken care of every step of the way. And if you're looking for a rewarding referral program, reach out to me at steven@roadwaymoving.com or visit roadwaymoving.com.
Okay, everybody, we are back. So we're talking today here at the table about, a tumultuous week last week, but a good week, an interest rate drop from the Fed. Now, everybody gets a little too excited about interest rate drops as it applies to mortgages. It really does not. We have Greg Heym here, chief economist, who's going to explain all of that for us and when maybe it will catch up to the mortgage situation. So let me ask you, the decision by the Fed this week lowers federal fund rates to an average between 4.75% and 5%. And while the rate sets short-term borrowing costs for banks, it does spill over into multiple consumer products like mortgages, auto loans, and credit cards. Explain to us what that actually means.
Well, to start with, the federal funds rate is a rate that banks used to charge other banks to meet reserve requirements. Before the financial crisis, banks had what they call scarce reserves. So they might need a certain amount of cash on hand to meet their reserve requirement, and they'd borrow money overnight from another bank. That's not done anymore. Since the financial crisis, we have abundant reserves. The Fed pays them interest on these reserves, so nobody really trades it. But it's really the mechanism the Fed uses to either step on the gas or step on the brakes. So the way they get the rate down is to put more money into the system, because then when something's plentiful, it gets cheaper, right? And the cost of money is the interest rate. So there is no direct correlation to mortgages because they're based on long-term expectations, really track the 10-year Treasury as much as anything. The one thing that comes from the Fed announcement is that they're very happy the progress on inflation. They're getting close to the 2% goal. They also have a second mandate. So they're not just responsible for one thing. They have two things they have to do: keep inflation at bay and maximize employment. So at a time when hiring is slowing down, the unemployment rate has risen, went down last month, but it's been trending up. There's been massive downward revisions to prior job gains. They can say, well, we should cut rates. That'll get the economy going, but they have to keep inflation in mind. They made a huge mistake a couple of years ago, letting inflation get out of control. But now they feel that, like you mentioned in your intro, by the way, one correction on that. Rates went to 6.09. That's
right.
It's the economist in me, and it's Deuce McBride, but we'll deal with that later.
He was reading really quick.
You can come on my show.
That was fast.
You can come on my show and fact check me. We'll call it even. But
it's perfectly okay.
So the thing about mortgage rates here is now the Fed feels comfortable. They've said that they expect to hit their inflation target by 2026. You go, wait a minute, why are they lowering rates if they haven't hit their target? They feel comfortable it's moving in the right direction. One of the big problems with inflation is the way housing is measured, which is basically in 6-month intervals. So a lot of people, including myself, think inflation's actually lower than it's being reported because they haven't caught up. If they checked in with the same pool of homes more frequently, I think we'd see that number sitting probably right at 2% right now. So for those of you who, and a lot of this is the media's fault. They keep saying mortgage rates are going to go down, mortgage rates are going to go down, and David can have fun with this, I'm sure, too. That's not what happens. But the same reasons the Fed feels comfortable cutting this rate, which will affect short-term loans. It will also affect savings returns, too.
Correct.
So say goodbye to the 5% money market funds. But that will bring mortgage rates down because they're basically saying we're winning the war on inflation. So that's going to, when you lower expectations for future inflation and the economy is slowing, you'll see that yield curve flatten a little bit. We had an inverted yield curve for a while. Now it looks more normal. But I think the thing to keep in mind is this is the first time the Fed has touched rates since July of 23.
Correct.
In that time, mortgage rates have gone up and down a lot. In fact, they're down 1% since May. So just keep in mind what really moves mortgage rates are future inflation expectations. The 10-year Treasury reflects that. This, though, is good news for pretty much anybody that wants to borrow money. Auto loans will be cheaper. Credit card rates, which obviously with record credit card debt is a big thing.
Well, that's what I was going to ask you, because actually, I read last week after all of this was announced that, and I don't use credit cards. I mean, whatever I use, I pay every month, whatever, but up to 25% in interest. Yeah. So you're reducing it by 0.5.
No, but
and people are getting excited about 24.5%.
Credit card rates have always been high. This isn't just a function of the environment. They've always been about 18% or more, depending on your credit score. I mean, now there's more transparency like that. I put these notes on the bottom of your statement saying, like, if you pay the minimum payment, it will take you this long. I think it's something, it goes again to the lack of financial education. I don't think people realize, On a regular loan, we call that usury, like charging somebody, 20% or more, but it's an unsecured loan and there's an inherent risk in that.
But as you say, people are looking at, relief personally in mortgages and auto loans and credit cards. So this is a great start. And hopefully if we reduce down the 50 basis points between now and the end of the year, that's now a whole point.
Right. They also issued their summary of economic projections where they talk about job growth, unemployment, inflation, and where they expect the federal funds rate to go. You may have heard the term the dot plot. This is the people that get together in the room, what they think. So basically expect another 50 basis points this year, probably 25 basis points at each of the next two meetings. They'll go a full percent next year and then another 0.5% in 26. Add that up, that's 2%. You add the 0.5% they just went. Yeah, and basically you're 2.5% cut, which gets you sort of back down to where things were before. I think the thing to remember too is people call mortgage rates high, or they'll say, the Fed has kept the federal funds rate too high.
Right.
Historically, that's not true. The 30-year conforming mortgage average over the last half century is like 7.7%. So mortgage rates to begin with 6 are actually historically low.
I've been saying that forever.
They are double what they were just a couple of years ago, and that's what we're going to focus on.
We all got used to those.
We loved it, but it had never happened before, and it may not happen again.
And it was planned to get there, where a lot of people, think that just because it happened, it was going to stay that way.
And also a lot of the real estate agents that entered in the last 10 years, if you think about it, what was the one thing that they said when they were trying to sell a property? Now's the time to buy. The rates are the lowest they've ever been. So if you've been selling real estate for 10 years, that was your excuse. And then when rates went up in 2022, that was it.
That's right.
So I want to bring a little bit about interest rates back to kind of like you went high level. I'm going to bring it back to like every day. So
I did that on purpose just so you'd have space.
So when we talk about what's going on with mortgage rates, so if we look at the last 2, 3, 4 weeks, the bond, so mortgages are tied to the bond market, right? And the bond market is one of the fastest absorbing news vehicles there are out there. It gets economic data, processes it, and boom, it changes, right? So the mortgage market was already expecting rates to come down for the next 3 Fed meetings. Of this one that just happened in September, the next one's in November, the next one's after that is in December. There's no October meeting. Mm-hmm. It had expected 1 point. And so that's why when rates last week, when they cut rates 0.5 point, the bond market and frankly mortgages were like, okay, whatever. What's next? Right? Everything's what's next? What's next? So what I've been coaching all of our clients and our real estate agents is stop focusing so much on what the Fed's doing with the rates. We're going to focus on economic activity. I've been kind of preaching the last year over. I called it the espresso martini index. Back in 2022, I had an espresso martini in February, I remember, and it was $24 in the West Village. By the way, I went on TV and talked about this, which is like, talk about if you want to embarrass yourself, espresso martinis and economy on TV. But it was $22. It was $24. And then when we went to, we looked back, it went from $18 to $24, right? And I knew that month in February, I was like, in March, we're going to see inflation go crazy. Rates are going to go up. It happened. Then last month, I did a teaser. And I went to the same restaurant, and it went down from $24 down to $20. So it's still not 18. So from an economic perspective, everyone's like, well, should you go back to 18? I'm like, no, but still, inflation is supposed to rise, in theory, at good levels, 2% a year. So that was my espresso martini index or test that I had done. To put it better in perspective of what we're gauging on how you can gauge interest rates through drinking espresso martinis. But it really does kind of set the tone.
I think I read a Federal Reserve paper on that.
Yeah, exactly.
Just being curious, because my favorite martini is a jalapeno martini. Yeah. So was that the same $24 range?
I did not test that one, but okay, I'm happy to. But so now, inflation's kind of in check. As Greg mentioned, everything about it's going to be about jobs now. So the jobs reports, there's going to be a private sector one, which is ADP that comes out, and then the Bureau of Labor Statistics. So when I'm coaching all of our clients, all those news alerts you get at 8:30 in the morning, that's your gut check. And so if anything feels like, for example, put this in the test. If a report comes out and says jobs are hot, well, jobs are hot, came in over expectation. That means people are going to spend money. That's inflation up. So what happens to rates? Rates up that day. If we miss a jobs report, jobs are down, means people are going to spend less. What happens? Rates come down. So that's going to be the concept that I want everybody in the industry to understand. You don't need to know much about economics, finance. It's just the gut check. What is that report telling us?
Right. So they have been coming down, interest rates, that is, for a while now, right?
Yep.
We're down to a fairly decent number.
Right about 6%.
Right about 6%, which, again, as you said, that's a very good rate. But let me ask you, Stephen, because, buyers out there, even sellers who want to sell and upgrade or downgrade or whatever, are reluctant because they're looking at 3%, they're looking at 4%, they're looking at 3.5%, whatever, maybe 5%. And they're like, well, I don't want to double or add to my monthlies. What is the perception out there this past several days? It's only been, 2 or 3 work days since that rate cut. Do you feel that buyers are aggressively starting to make moves, meaning pay attention again, get out of that house, as I always say, start running down the street again? Or are they still kind of waiting back a little bit because they're not quite sure where it may end up?
I think a lot of real estate agents would tell you that this August was pretty busy.
Yeah.
And it continues to be busy. I think that has a lot to do with consumer confidence among buyers. A lot of them are coming out of the woodwork, I think somewhat tepidly, but they are out there looking again. There is this concept, and I actually use myself as an example. I bought my apartment in, I want to say 2017. I got a rate of like 3.2 or 3.3, right? Mm-hmm. And now here we are. I've outgrown that apartment. Mm-hmm. But in order for me to move, I'm going to have to take a higher rate. And therefore, not only am I making a leap in price, which would be expected if you're moving from, one apartment to a larger one, but I'm also going to be taking a leap in my mortgage rate. And there are people across the country who are in similar situations to the one I just described, and it's not so appealing. So they have to really think about it if they want to make that move. What we often say is there's the 4 Ds. You guys know this one? Death, debt, divorce, and diapers. And these are the 4 Ds that
I haven't heard that in a long time.
Yeah,
that mean you have to sell, you have to move.
Yeah.
Other than that, a lot of the time it's a choice.
Well, and I talk about it every week. In one of the buildings that I sell almost exclusively, a lot of first-time buyers who are now sellers who say, look, I've been here for 10 years, 15 years, 12 years, whatever. I have a great low rate. I have outgrown my apartment, or I need to downsize, whatever. And I've got maybe 8 or 9, probably 10 people waiting on the sidelines to list and go. But they're like, well, when is that time going to be? You indicated it before, and I see it all over social media. Now's the time to buy. Agents jumping on the bandwagon. Rates have come down. Rates are coming down again. Now is the time to buy. But in fact, they're not.
Well, you have to. The problem is a lot of people, and David probably gets this, a lot of people that called him and said, let me know when the rates hit 6, then I'll go. And now at 6, it's like, oh, they're there. Let me know when they hit 5.5. Let me know when they hit 5.
To be honest, so I've been saying, I think last time I was on the show, I said, when rates go under 6, it's going to create a frenzy, right? Mm-hmm. And guess what? The national average is above 6.
Yep.
But if you look at New York City specifically, most of the rates are already under 6 because New York is a much more competitive market, so the banks tend to price a little bit better. And so most of the rates that we're seeing are right under 6.
And people forget this. There are other options. It's not just a 30-year fixed or bust. And if you do wait, you say, well, I'm going to wait because it's like when the prices are going down. It's like, I'm going to wait till it hits rock bottom. If they're going to wait for the rock bottom rate, what's going to happen is there's a lot of people. I know you mentioned that people are hesitant about, but a lot of people still have that. There's still the demand there because we are still adding jobs. The economy is still decent. People, especially in other parts of the country where there's no inventory, it's gone up by about 20% year over year, but it's still low. People are going to jump at that rate because they've been waiting and they're desperate. And then when the person who's sat on the sidelines, they're going to find the prices have gone up to the point where it's canceled out the low rate. Yep. You can't change the price you pay for something, but you can always change your rate.
My nephew called me 2 weeks ago. I think I mentioned this last week on the show. He and his new wife are buying a house in Connecticut, a local bank. And so I first thought, I don't know, whatever. You really want to go to a local bank? He got a 5.5% adjustable rate. And when mortgage rates go down, obviously he can go down as well. So he's sitting back thinking, well, I guess I did fairly well compared to what's been going on out there. And I said, Danny, you certainly did.
Yep.
Hold on, see what happens in a year or 6 months after all of these rate cuts start affecting the mortgage interest rate, and you'll go from there. We got to take a quick break. No one's going anywhere. This is Talking New York Real Estate on the More Network. We will be right back.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
All right, Greg, so question to you. I think I mentioned this at the top of the show. Could the rate drop lead to a resurgence of inflation? And if so, how does the Fed Reserve plan to manage that risk in the long term?
Well, obviously, when you cut rates, you run the risk of cutting too much too soon. Now, remember that anything the Fed does, whether they're cutting or hiking rates, takes 6 months to a year to really impact the economy. We talked about the rates it will affect right away. So that is a question after, again, really, screwing up, letting inflation, pretending like it wasn't a problem, calling it transitory, even though the money supply had been increased by 40%. They were so irresponsible then. They have to be the adult in the room now, and I think they've been pretty patient. Other central banks started their cuts before, and I think they will keep a watch. Even these projections we talk about, there's always the big asterisk. Like they're going to go based on data, like David said. They're going to look at the jobs reports coming in. I was a little surprised after retail sales came in better than forecast. For last month, I thought that maybe they might go 25 basis points. But I think a lot of people say, well, if you're going to cut, by 1% before the end of this year, why not just front load it? But they tend to hike more aggressively than they cut. So, yes, it could be a problem. Remember that we haven't hit that soft landing yet, technically. We haven't gotten down to the inflation target, and we can't rule out a recession because there are some troublesome signs out there. You heard about this new scary thing, the SOM rule, and about how fast unemployment goes up. You worry about the jobs numbers because after the massive correction, over 800,000 jobs disappeared during the 12 months ending March. When we get the employment report next week, what will the prior 2 months look like? Because every report, the prior 2 months revised, and last month there were huge revisions down to June and July. So I think that's the concern for the Fed. But when they talked about the balances being equal, they're basically saying, okay, we can cut because inflation's looking good. Obviously, it would be a disaster if inflation started to pick up again and they had to just keep rates steady for a while, or God forbid, even start hiking, because then it smells of panic.
Right.
Like you guys don't know what you're doing.
Well, that would totally be panic. But what sectors, in your opinion, of the economy, real estate, automotive, manufacturing, are expected to benefit the most from these lower borrowing costs?
Well, anybody.
We're getting there on the mortgages, but what
Well,
else?
obviously, any business that relies on people taking loans, right? So you would expect auto sales to do a lot better. It's not good for banks typically. It really depends. Although again, the savings rates will go down, right? It's not the ideal environment, right? It's not. It's not always the. I think that obviously for consumers, it's great news. And since consumer spending is 70% of gross domestic product, it bodes well for economic growth. Again, it will take time to see any real results, but. The question, though, is when consumers already have record credit card debt, do we want to give them incentive to go out and run it up? It's like, I'm only paying, 20%.
I will say, though, what we are seeing a lot on our end, home equity lines of credit have come back in closed-ended seconds, like second mortgages. So people that are stuck in that 2-3%, we're seeing them, if they did get into trouble with credit cards, they're coming back and taking out home equity lines. I just had a client who... amazingly, their kids got into Ivy League schools. We had to do a home equity line of $300,000 because they're like, it's a ton of money. But this interest rate cut is, a lot of HELOCs are based on the prime rate. Prime rate immediately came down.
Right.
So it's going to benefit some people. And yes, there's still higher rates in regular.
And obviously with HELOCs and refinances, right? Remember those? It's good for the construction industry. It's good. It's good for
Let me tell you.
people that sell materials.
I've gotten so many calls. Last week was free advertising for refinances. Our clients that closed in October, November, December of last year were already in process to refi. They literally paid a couple months of mortgage rates at the high 6 and 7s, and now we're refinancing everybody. And so think about all the concessions that New York was able to give for those clients that bought in those months, and now they're just laughing because now they're getting rates. I'm doing refis.
They're laughing all the way to the bank to refinance their loan.
We're doing under 6%.
And pay all the friction costs that have to do with refinancing.
Well, along those lines, though, the adjustable rate, people who have adjustable rates, how soon can they expect to see a difference in a new rate and then, of course, lower monthly payments? I mean,
well, we're already seeing it. So even if I had a client that did an adjustable rate in January or February or March,
right.
I generally say, again, it all depends on the loan amount. The kind of sweet spot is if your rate improves over 0.5 point, you're going to see a monthly differential of savings that will cover the closing cost expense within 36 months. I want to see a break-even timeline of 36 months, savings versus how much it costs to do it. And in New York, our closing costs are significantly higher. In California, your break-even can be like 12, right? Your closing costs are so much less. But a lot of our adjustable rates, doesn't matter if you're in an adjustable rate or in a 30-year fix, it's really what's the rate today on the new product, and are we saving enough to break even in 36 months? That's my refi kind of test.
What about, Stephen, the reactions on these cuts by first-time buyers, okay? People who have mortgages already, who want to sell, can't sell, don't want to double, as you said before, their monthly payments, whatever. But what about first-time buyers? Are they looking at this new climate any differently than they were 2 weeks ago?
I think they're hopeful. And I don't know that they're looking at it any differently than they were 2 weeks ago, because I think there's been so many rumblings about rates coming down. So I think that there has been increased consumer confidence among buyers of just about every price point. What I was just thinking about, and what I will tell you, is that all of any real estate lawyer or real estate agent really that you speak to will tell you that there's been a record number for them of cash deals in the last number of years. Of course,
Absolutely. A lot.
But what we're finding, though, is that even wealthy people who are paying cash and they therefore think they should have a lot of options, they're getting out there and the inventory isn't there. And that's been a very interesting and frustrating thing as an agent, when you don't have as much to show them as you would like to, and nothing is feeling quite right when you get in there. What I also will tell you, though, and back to sort of the more affordable first-time home buyer area, there are a lot of smaller apartments that are priced really well, and it seems as if they are languishing a lot on the market because of the rates, because these are not called all cash buyers. The first-time home buyer is often planning to finance, and they're not out there in the same way. So what we're finding a lot is that the luxury sector has been doing quite well, whereas the more first-time starter home, much less so.
So talk a little bit about inventory. Do you see that increasing a little bit now, or not?
I hope so. I mean,
we're all hoping for it, right?
I'm hoping that this will thaw the market at every price point. And I'm hoping it'll affect the rental market as well, because you have a lot of would-be first-time home buyers not leaving their rental because the mortgage rates have been higher, and there's supply and demand issues. So the rental market is now really tight, really expensive. It's been that way for years.
What's amazing to me? It's all psychological, in my opinion. Why? They'll stay in their rental. They'll get increases that have been beyond, recognition, instead of saying, and here's my plug as a real estate agent, buy. Because if you're concerned about higher interest rates, in the past, would you rather pay a higher rent?
But think about it for a moment. My generation has sort of, let's say you've been in the job market and since school, whatever, for the last 10, 15, 20 years. Your parents and your grandparents built a lot of their wealth by home ownership. Yeah. And you look at young people today, and they have seen the market go up and down and up and down. Yeah. There are people who bought their apartment in New York City 10 years ago or 2017 or whatever, and they're lucky to be breaking even. So they're now saying, well, if I stay in this rental and keep paying an expensive rent, I might be able to take that same down payment money that I have been saving up and put it into a different asset class, because real estate market is no longer the slam dunk that it has been for generations.
And as we used to tell people all the time, invest in real estate, not in anything else. Speaking of anything else, Greg, talk to us about a little bit about the stock market, how it zoomed and boomed one day after the Fed announces this wonderful, 50 basis point cut. Broke records on Friday. How did that happen? Why did that happen? And what did Wall Street expect from that cut?
Initially, they were a little concerned because it's like, wait, why is the Fed going 50 basis points? Is it really worried about the economy?
Right.
Because, I used to always say on my podcast, be careful what you wish for. We all wanted to see slower job growth, slower consumer spending so we could get lower rates. But you only get those lower rates when the economy is slowing down.
Yeah.
So it's a fine line that the Fed has to walk. And again, the Fed in its history has basically only engineered one soft landing, and that was in 1995. So they're not very good at it. There's always going to be the concern. But Wall Street is, all about the now and the future. They don't look at yesterday or the day before that. I think the problem is that there is always a concern that stocks are overpriced, particularly tech stocks. We've seen what happens in NVIDIA on certain days. It's like a backlash against them. So, but they are looking at the fundamentals, as are we. And David mentioned the data. They're more focused on data. You see what happens when a bad jobs report comes out or, a good inflation report. Like you could have one day where you're like, oh no, look at these job revisions downward, look at the unemployment rate going up. And then next week the CPI data comes out, about as expected. You go, forget about what happened last week. We're doing really good now. So I think the fact, plus remember, September is historically the worst month for stocks. And this is the first time since 2019 that it looks like we're going to have a winning September. Let's hope that doesn't change and I didn't jinx it.
Yeah.
But, it's just... It's amazing, and that's another good thing for us here in New York City. Wall Street bonuses are going to be huge again because Wall Street's having an amazing year. The Dow, NASDAQ, and S&P, just every week another one of them hits a record.
Yeah.
And I think there's an optimism that we're getting the rate cuts. Look, economic growth has been good. It's not like we were on the verge of recession. No. And I think consumers have found a way to keep spending even though they have record amounts of credit card debt. So I do think that, the stock market, people always ask me, like, I want a chart of the stock market versus real estate on returns. I want to prove that real estate, has a better rate of return than stocks. And I always say, no, it doesn't. But you can't make that comparison because, the person who doesn't buy has to rent, right? That takes away from your costs and you're not fixing your costs. Taxes are going to change, but your payment, can always go down eventually. So it's not a race. I do think that, just like after the financial crisis, there was sort of a backlash for a while of people that didn't view home ownership the same way. Then they kind of came around. I think now you're seeing a similar thing because prices got so high, mortgage rates got so high in their minds because they only knew low rates. I think in time, the Gen Zers, by the way, who have a higher home ownership rate than the prior two generations did at that age because of the lower rates they were able to take advantage of, I think they'll come around too.
What about international trade and foreign investment in the U.S. economy as a whole on a national level? Do these rate drops affect that significantly enough where there will be an increase?
It can weaken the dollar, which is good, right? For real estate. It's a double.
Getting foreign national calls already.
Yeah, see?
For mortgages.
It's a double-edged sword, though, because like when the stock market gets very volatile, a lot of agents will come up and say, well, this is good for real estate because they're going to now put their money in real estate. If it goes down enough, it's not good for anybody.
Right.
So it's funny. Everybody says, particularly politicians, we want a strong dollar. And the question is, well, why? Because a lot of people that sell to international buyers, like real estate agents, they don't like that. We don't want to hear that at all. And so I think it's good. Obviously, the international buyer hasn't really come back to the level they were before COVID,
right,
for a variety of reasons. Sometimes it's the inability to get the money out of the country they're in, and you throw in a couple of wars going on, and it creates a global turmoil that. But also, it has people looking for safe havens, and the U.S. dollar is still the world's preferred currency, and New York City real estate is still proven to be a very stable, long-term investment.
So, David, how is this all affecting, the customers that come from international. You say you're getting lots of calls about that. What are they asking about, and what are they planning to do in the short term?
So finally, because the dollar is becoming more attractive from its highs, you're starting to get calls that, they're sitting on a lot of cash externally, and they want to diversify their assets, right? They want to bring cash here and invest it in New York City real estate to grow here as an alternative asset. But the point of entry has been too high because the dollar's been so strong. So as we start weakening, as we lower interest rates, one of the positives for them is that the dollar weakens. It's going to be terrible for all of you that want to go buy, Louis Vuitton in Paris, but whatever. So,
Sorry, Vince.
yeah.
maybe for Christmas.
But so we're starting to get those calls. And what I'm finding even more interesting is the appetite domestically for some of these banks that do foreign national loans. They're getting aggressive. Like, these rates used to be high. I mean, Vince, 8-9%.
Yeah.
I'm seeing high 6s and 7s on the foreign national right now, which I have not seen. I was like jaw on the floor when I saw this. So that's actually surprising to me. And I think we're going to start seeing more people come in, not huge loans, but maybe 30, 40, 50%. And they're going to, kind of diversify themselves.
Well, as Greg said before, could be, the lack of international buyers. And when I'm teaching, foreign buyers and sellers in continuing ed, I say the same thing. Problems taking into our country money from their country. How does that affect them when they're asking you for a mortgage, for a loan? I mean, the more money you can put down,
Correct.
right, the better. So if they're restricted in how much they can take in, are you able to qualify them in a higher mortgage amount? Because they're not from here. They don't live in the U.S.
So there's a couple different approaches on the foreign national side. You have some banks that are going to look at their income at their home country, and a lot of foreigners don't want to show income.
Right.
And then you have separate loans that are, and not to go too deep in this, but they're called DSCR loans, debt service coverage ratio. And the way that these loans work is they look at how much income is coming in on that rental unit. Mm-hmm. And as long as the income covers all of the expense on a monthly basis, mortgage, taxes, maintenance, insurance, the bank's willing to give a loan. So clearly on those, you have to put a lot of money down because, the rent to cover the expense, you probably are putting 30, 40% down. But a lot of foreigners do those type of loans where they are not having to show a ton of income from their foreign country because they probably don't show a lot of income in their country for tax purposes. But they put money, 40, 50% down, bring some money onshore here in the U.S., create an LLC, and then we're financing it that way.
We're going to talk about the current state of the market in a minute, but in the interim, Stephen, what advice are you giving to buyers and sellers now? Meaning, when they call you and say, hey, all this news about interest rates, or hey, I still really want to sell my apartment, or I really want to buy something. I mean, how are you having that conversation with people? I mean, a recent conversation I had was, look, I've been saying for a while now, it really is a great time to buy for all these reasons. And now with the help potentially of rates coming down on the mortgage end, it's going to be better. And by the way, before sellers start to increase, and I wanted to ask that question as well, they're asking prices, why not jump in right now? Because that will happen.
It's interesting, and there's the inventory conversation, of course, is part of it. But I have a number of buyers now who have been looking. Inventory hasn't been great, and thus they haven't found what they've wanted, and they are getting a little bit nervous about the increased competition as more buyers enter the market. The hope is, though, that inventory will increase as well, and therefore they will have more choice. As far as sellers go, I think good product that's priced well is still selling. I think sellers, if they're really serious about selling, need to be realistic about pricing, and that's been the case for a while now. We're no longer pricing, above value with room for negotiation. We're pricing much more tightly. That strategy has proven effective, and that's that's not that none of that is particularly new in terms of pricing. But I do think that there is now an additional amount of pressure for buyers that are currently in the market that they're going to be having more competition.
Well, and you know how sellers think. I mean, the minute they start seeing that there's a lot more buyer activity out there,
Raise the price.
what do they sit back and say? Raise the price. I'm not asking enough money for this. I mean, I've already got one saying that to me, and I'm like, no, not just yet.
Yeah, but I I think keeping the prices where they are, if buyers are going to be coming out of the woodwork as expected, with and as we say, New Yorkers are not good at delayed gratification. So a lot of these buyers have been putting off this purchase for a long time now. In the perfect world, your seller's going to have multiple bids and have choice of buyer.
100%.
If they raise the price, much less likely to happen.
Correct. And they might get over the asking price. So there you go. Instead of raising, you might get more. All right, we're going to take a quick break. We'll be right back after this. This is Talking New York Real Estate. Don't go anywhere.
What do you really need to know about buying or selling a home? First, it's serious business. And it's complicated. There's a lot of money on the table. And emotion, too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.
Okay, we are back. Stephen, make your point again, please.
All right. So what I was just...
Renovations and lack of renovations and the need for people to want to buy something that's more finished.
A lot
than
of
not.
your larger apartments on Central Park West and Fifth Avenue and Park Avenue, these are homes that have had the same people living in them for decades and decades. Right. Perhaps this person has passed away. Perhaps this person is downsizing. So we have a lot of property now that needs renovation. It needs often a gut job, not just, a couple bathrooms here and there. And you have a lot of buyers out there. Younger buyers have often never taken on a renovation. They don't know how to do it. They've gone from, glass and steel rental to new condo. So this is overwhelming to them. Plus,
or their parents renovating and they don't have to get involved in that.
And then there's the whole supply chain, issues. The fact is that a lot of these pandemic-related supply chain issues have been worked out, but perception is reality. And when they sit down and talk with their friends and hear about all the nightmares of renovation, it scares them off. So I would love to just sort of ask the experts your thoughts on how interest rates are going to affect the cost and all the other aspects of renovations, because that is a big issue in our market.
You mentioned supply chain. We're facing a longshoreman strike that could bring those problems back and cost the economy billions of dollars. But let's hope that doesn't happen. They have till the end of the month to get it worked out, which is next week. So hopefully they're trying hard. But I think the thing is, because when I talk to appraisers and my good buddy Michael Vargas about this, because I get asked that, like, what year are we back to an unrenovated co-ops? Right. Some people say 10 years ago, because inventory may seem scarce in Manhattan, but it's really not. It's kind of balanced. I know people say, well, nobody wants that inventory. It's all overpriced.
Right.
So, but buyers do have more options than they do in other parts of the country. And like I said, they don't want to do the renovation. Lower rates will enable them to take either a higher mortgage or a loan for the renovations. Lower inflation should make the cost of materials lower. Wage increases are slowing. So that should help that. But again, as Michael Vargas likes to say, if you did your kitchen 5 years ago, it's not renovated. Like, people forget, new is new. Like, that, it's not, we have this in here and it's great. And it used to be this mechanism where, you probably heard it a million times, where a seller goes, well, I paid this for it, I put this much in it, I want this much. The buyer doesn't care about any of those three things in a market, especially co-ops are the value, right? All things being equal, they're going to be cheaper than a condo because of the underlying mortgage, the rules. It's harder to renovate. So that's the entry point for a lot of people.
There's a new challenge. Popular. Yeah, because, and this is going to be wildly unpopular.
The views expressed by David are his own and not
exactly.
New York real estate.
My biggest issue in New York City, so everywhere around the country, we do these Fannie Mae home style loans where you can literally price in the renovate. You're buying a $500,000 house, you can put $200,000 of renovation. The bank's going to give you, and we add a padding, but for simple numbers today, $700,000, 5 plus 2, right? And we'll let you put down 5 to 10% on that $700,000. Everywhere around the country. You come to New York. If you want to do a renovation on a co-op, what does the co-op want? 20% down, 24 months of reserves, and reserves
more.
And reserves for the renovation. So all these products that exist, in my opinion, and here's the unpopular
opinion.
And
post-closing liquidity, a lot of sometimes like double the purchase price.
Right? So my unpopular opinion or disclosure here It's the boards that are stopping the renovations because you have to be basically all cash plus in order. So like people that were buying cash and going to do a renovation, they still take a loan so that they can show enough post-closing for the board, which is just wild. So it's the boards that are stopping the renovations in New York.
But on top of that, if you think about it, the apartments that need work are sitting longer. In any given market, something that doesn't need work is good. The audience for apartment that needs work is always going to be smaller than an apartment that doesn't need work in just about any market. So in today's market, what is happening is because of all the issues that we just talked about, inflation of materials,
supply chain,
workman shortages, right,
quick renovations,
all of it. And then what happens is the apartments that need work sit longer. They take more price cuts, and then what happens? The people who step up to the plate are less likely to pass a co-op board because they're the ones, because these apartments are now coming into affordability for them. And maybe they'll do a less expensive renovation, maybe they'll put it off. But now we're having to often bring people to boards that are borderline in terms of what the board is going to pass.
Take the same concept and go to Bed-Stuy. Look how many developers have jumped in and renovated, or clients or people are taking HELOCs to renovate, and those places are selling. And a lot of the first-time home buyers. So when I look at first-time home buyers, I think of like a big housing, or the big stock of them here are the Googles, the Apples, and think about it. Their stocks have gone through the roof. Every time I start a pre-approval call, I ask like, what was your motivation to buy? And it's never like, I want the American dream, or like, it's none of that, right? I'm like hoping for mushy.
Buy a piece of the rock.
And like, I get the hard, fast, I'm tired of renting, it's too expensive. And I'm like, well, give me some like love. Like I want to make the story. It never happens. And so these clients are stuck, quote unquote, with their Google stock that's gone through the roof, and they want to diversify it. So they're buying and using their Google stock, which is part of their compensation. It's been a huge wealth aggregator, which so we're very thankful for that in New York City. But they're going out and they're buying renovated in Bed-Stuy, which is a 45-minute commute. And they love that stuff. And so look at what that has done for that neighborhood. Imagine if the co-op boards would allow these renovation loans.
Well, getting back to the co-op boards here in New York.
The commute, David, if you think about it, if they're only going into work 2-3 days a week because of remote work, that commute is now off the table and doesn't even matter.
Absolutely.
So they're going where they're going to get the value.
Absolutely. But I've had a couple of buyers say to me recently, co-op, that, well, the way the market has been and the way the prices really haven't increased in value and whatever, I'm really kind of hesitating spending a couple of $100,000 in renovating this apartment, because if I need to put it on the market for sale a year from now, 2 years, whatever it is, I don't know that I'm going to get it back.
Yeah.
So they're being restricted in their own mind.
It's a risk-reward scenario. But look at the people that went to Upper Manhattan 20, 30 years ago.
Right. Or
people that bought in Bed-Stuy or in Williamsburg or Long Island City and got in early, or downtown, in the 80s and early 90s. There is a reward to putting in the work and making a home. You get to really build it yourself. But the co-op boards are obsessed with protecting value in buildings. That they view that as their job. But unfortunately, making it very hard to do renovations or rejecting buyers because maybe you don't like the price is actually, I think, doing the opposite.
Greg, let me ask you from a high level, position. What do you see right now as the state of our real estate market here in New York City, just in general? You seeing more deals, not enough deals, getting a little better, not necessarily getting better?
Getting better for sure. It was a good August,
August was
just
busy
compared to last year, but in pre-COVID. We always look like pre-COVID world, right? And it was a good August. We're seeing uneven activity, like we do these weekly contract sign reports in Manhattan, and 1 week it's the under $1 million, the next week it's the over $5 million. It kind of it doesn't make some sense sometimes, but you think only a couple hundred apartments go into contract in a given week, so you're going to have wonky data. That's an economic term, wonky. So I think it's good.
I'll adopt that term.
Lower rates bodes well, and the thing that's different about New York is, and particularly Manhattan more than the other boroughs, when the rush happened after COVID, the reopening, inventory was absorbed real quick and prices shot up in most parts of the country. We didn't have that here. Prices, there was a delay. We couldn't show property for several months, and we had a lot of inventory sitting around. So prices didn't move much. Then came 21 into 22, the greatest, also known as the greatest time of our lives, where everything was flying off the shelves. Prices didn't move that much. You know, we didn't get too happy. We didn't get too sad. So unlike the rest of the country, existing home sales were down last month in the U.S. and have been down the last couple months, even as mortgage rates have been falling because the prices are still too high. I don't think the prices that we're seeing, and you talked about this, Stephen, they're not historically high prices.
No.
So we have that bodes well for us. Buyers started jumping in as the rates started to come down. Now that they're poised to keep going down, the Fed has kind of said that, again, not by the 50 basis point cut, but by saying in their statement, inflation is moving towards our goal. We're pretty satisfied, you know, with the direction it's going in. That is going to get people to jump. And, you know, there was a survey done that I've talked about a lot a couple of months ago. They'd ask people, what mortgage rate's going to get you to jump in? How low is it going to have to go? And the average response was 5.5%.
Yeah.
And they said, why that? Well, that's what they are historically.
Right.
Actually, that's not true. They're over 2% higher than that normally. But okay, if that's what it's going to take, we're getting close to that number. Again, people will get greedy. And if you try to, it's bad enough when you try to time the price. Like, I'm going to buy at the bottom of the market. You're going to miss it because you're going to find out 6 months too late when the market is bottomed. Trying to time a rate is crazy. I think
that's what I'm dealing with on my refis right now. And everyone's like,
You can't.
should I wait? I'm like, you're saving $700 a month with one client. And I'm like, if you wait, I'm like, that's every month you wait, you're losing 700. I was like, we can always refinance again when in 2025, 26, you know, and so time, you cannot get greedy.
I always say, always look at downside risk. You know, the upside would be, yeah, if you waited, the rates would come down more. But like you said, if you missed the boat, you know, there's been times during these higher mortgage rates where there's been a burst in refinances because the rate dipped a little bit and people couldn't wait any longer. They waited as long as they could. And if you do that, because I went through this before I bought my home, we weren't serious enough, you know, so it took a while. And then we bought in 2006, the worst time I could have bought Long Island.
Yeah.
I love the house. I don't regret it for a minute. And the mortgage rate's half of what it was when I bought. So that takes away the sting. Situations change. People may feel hopeless. I can't find anything I can afford. There's nothing for sale where I live. How am I ever going to make that mortgage payment? The insurance has gone up. You know, 1 in 8 homeowners don't have homeowners insurance right now in this country. And those people, a lot of those people have mortgages, David. That's not supposed to happen.
It's not supposed to happen.
So they look at that and you have to remind them, look, hard times have happened. You don't have to go back that far. The financial crisis wasn't that long ago. You know, the tech bubble bursting wasn't that long ago. We all have that. So I think you have to remind them things change. And, you know, if you want a home, find me somebody who lived in a home for 30 years who regretted buying it. It's not going to happen.
Absolutely. Stephen, from an agent perspective, what should the expectation be between now and the end of the year? 3 months to go for the end of 24 and then into winter of 25. Business picking up, business kind of flattening out. And let's keep in mind, 7 weeks from now is a major presidential election. So where are people's heads?
I heard that in one of the
You did?
Yes, in one of the offices, I actually don't know which firm it was, but I heard that some manager like popped a bottle of champagne in the office the other day.
I wish it were mine.
Right, when they announced the rate cut. I think that's a little bit overconfident.
Right.
I am hoping that we see a certain thaw in the market that we've all been waiting for. I think, as I mentioned before, New Yorkers they're not good with delayed gratification. There's a lot of people that have been putting off, and they have outgrown their homes. They want to move. So we are all hoping for a certain amount of market thaw. And of course, as buyers come out of the woodwork, hopefully there'll be more inventory as well. That is what I hope. I'm not an economist.
You said that like it's a good thing that you're not an economist.
Well, I had one of my guests last week who's fairly regular on the program here. He predicts, and he's been predicting for months now, that probably not till February or March of early 25, which is not that long from now, we'll start seeing a little bit more of a rolling difference, meaning much better, much better, much better.
Well, you're going to see inventory start to go up,
and
then.
inventory
Wall
go
Street
up too.
bonuses.
Right.
Bonuses will
Right.
be
Well,
over
they'll be
30
paid out.
billion
I'll be honest,
again.
the first-time home buyer is out with a vengeance right now. My pre-approvals are up.
Yeah.
We're probably up, I'm going to say double in the last few weeks of
That's
initial
incredible.
first-time home buyer calls. We're seeing people even in the 4 million range calling again that I haven't talked to in 3 years. We're seeing a lot of pickup, and I'm the one that gets the call first in terms of like, hey, can I afford this? And so these clients are still searching. And what I'm telling all my agents, everybody you talked to 2-3 years ago, get on the phone, because guess what? They're calling me and not calling you. They're online. So we need to get back out in front of our market.
They want to understand what they can afford before they maybe call us to say, hey,
Exactly.
I'm
Getting
because
pre-approved
what we
also.
say is getting pre-approved, because I'm not going to work with anybody who is not pre-approved, right?
Can you give me your anecdote? What you always say about first-time home buyers? How like they're kind of the rush that they do when this. I love this because this is coming.
Sorry, audience, but I'll say it one more time.
I just love it.
I say it almost
Repeat
every
it.
week.
Repeat it again.
Look, it has been my history, okay, 22 years in the business. Whenever we're in a buyer's market, a defined buyer's market, where the hell are the buyers? They're not out there buying. They're home, under the bed with the door locked. And they don't come out until they hear, I think I've heard something about, flip that switch. It's now a seller's market. What do? They get themselves out of under the bed, not even in the bed, under the bed.
Take the cash out of the mattress.
Take the cash out of the mattress. They open the front door and they're running down the street with their hair on fire because now they can't buy fast enough.
Because
and what do
there's
they
no fear
do?
of missing out.
What do they
in
do?
that
They
situation.
overpay. They get involved in multiple bids. There's bidding wars and bop. And I say to them all the time, where were you when it was on your side?
So now the interest rate means nothing, and this is why I love this, because
And
it's just
it's
like
true.
it's coming.
It's coming.
We're a few months away.
I see it.
It's already there.
There is a thought though that everybody is happy in a seller's market and nobody is happy in a buyer's market.
100% agree.
Because if
I am. I like seller's market.
Of course we do. Sellers obviously are happy in a seller's market because they're getting their prices,
Absolutely.
they're possibly getting bidding wars, and then buyers end up actually. It's good for them too because they feel like they won.
But what do buyers
And then-
say to you in a seller's market? I have to buy now because if I don't buy
Right.
now, the prices are going to go up. They're going to
But-
continue going up. And I'm
but
like, okay,
If
you're
it's
right.
truly a seller's market, then the product that they buy will increase in value the moment they close because it's still
It's still going up
right.
during that period. Yeah.
Whereas in a buyer's market, obviously sellers are not happy because they're not getting their numbers. And then the buyers come out and they say, why am I the only person bidding on this house? What's wrong with it? What's wrong? What's the problem
we
with this?
all get asked that question, like when's the right time to buy or where should I buy?
Right.
You want to buy when nobody's buying. If you're purely concerned about getting the best price, you go where inventory is the highest because that's the most negotiability. But just like any other investment, Warren Buffett always says about stocks, Wall Street's the only place when there's a sale, nobody buys, right? When the stock's going down in price, nobody wants to buy it. No one wants Bitcoin when it's going down. Nobody wants whatever gold when it's going down. It's on sale. You don't want it. Like it's the same product you wanted. If a car was cheaper, you'd buy it, right? But for some reason, people don't feel the urgency. And I think if you've been waiting, this is your opportunity now. From a price point, you may have more leverage now than you've had in a long time.
Yep.
So most negotiability probably post-COVID in many parts of the country. And if you wait till rates go down, you're going to have too many other buyers out there and the prices could turn around and start going up.
If you're a real estate agent and you're slow right now and you need to feel that like activity, go to the outskirts of Brooklyn, Queens, do the $600,000 to $900,000 purchase
Absolutely.
price. A lot of those clients qualify for certain type of grants too, based on their income or where they live. Fannie Mae has amazing grants, and a lot of these clients have 5 or 10% down that you can negotiate. So the thing is, we in New York City always only focus, and that's the $1 million listingization of the world. We only focus on the 2 million and up, but we have to realize, what's going to
Tragic.
get you activity right now? The 600 to 900. And guess what? I do it all day long. I love those people.
You're absolutely
First-time
correct.
home buyers, they're
You're
paying
absolutely
$4,000
correct.
a month right now in rent, and they will buy right now because they're tired of paying rent.
Speaking of which, I have a fantastic 2-bedroom, 1-bathroom home for sale in Clinton Hill, Brooklyn, asking $699 with laundry in unit.
That's
out.
Stephen Gottlieb. Give him a
Call
call.
me.
All right, we have 20 seconds left. Mr. Heym, close us out on your predictions of how many more cuts this year and at what percentage?
Well, I'll take the Fed at its word. Another 50 basis points. I think mortgage rates are going to continue to drift lower, not in a level equal to those cuts because of all the reasons we talked about. You see the spur in activity now throughout the country. Inventory has risen, but again, it's still a seller's market in most parts of the U.S. So my takeaway from this is talk to your lender, talk to your agent, find out what you can afford, what that gets you for your money. If you're happy with it and you have a need for it, pull the trigger. Because if you try to time the rate and the price, that's never going to happen. Doing one of them is never going to happen. Trying to do them both at the same time would make you the smartest person in the world. And it's a long-term thing. I know, Manhattan in particular, we always talk about trading up. Stephen needs a bigger place. That's good for him. But
Goals.
But most parts of the country, people will spend longer in their home, and it's really an important thing for them. I think situations change. Rates can change, but finding a house you love is not an easy task. And for some people, it can take a while. In a heated market, which is what's coming next year, especially in the spring when that spring market gets active and more inventory hits, I think it's going to be a frenzy. Right now, you have the opportunity to get in before everybody is calling David and getting pre-qualified. Now you have a chance for a lot more negotiability. If you wait until next year, I think you're going to have a harder time.
I totally agree. Stephen Gottlieb, David Rodriguez, and the infamous Greg Heym.
Infamous.
Thank you.
Do people have that low an opinion of economists?
Thank you for being at the table with us. We're coming right back with my thoughts of the week. Don't go anywhere.
Hey, it's Stephen Bailey from Roadway Moving and Storage. As an official moving partner of Brown Harris Stevens, we know that your clients deserve more than just a move. At Roadway Moving and Storage, we turn moving into an experience they will love. From specialized services to a white glove treatment, we've got it all covered. When you choose Roadway, you're choosing a peace of mind for your clients. Plus, our referral program is the most rewarding in the industry. Want to learn more? Shoot me an email at steven@roadwaymoving.com or visit roadwaymoving.com.
All right, everybody, we are back with my closing thoughts for this week. In New York City real estate, change is the only constant. The market is notoriously dynamic, influenced by factors like shifting demand, evolving neighborhood trends, economic cycles, and regulatory changes. One year a neighborhood may be the hottest spot, and the next, development pressures or market corrections could completely alter its trajectory. Zoning laws, new construction, and policy shifts like rent control reforms or tax changes continually reshape the landscape. Whether driven by global financial forces or hype local developments, New York City real estate is in a perpetual state of flux, requiring adaptability and forward thinking always from buyers, sellers, and investors alike, not to mention the flexibility of agents. And interest rate changes that halted the market for almost 2 years have changed a bit last week. Time will tell how that will shake the buyers up and get them running down the street with their hair on fire once again. The financial markets have already taken notice, and the holidays are approaching, and a major presidential election year about to happen. Happy fall, everyone. And that's our broadcast for today. Thanks to my guests for being here on set with me. You can follow me on Facebook, on Threads, Instagram, LinkedIn, or TikTok at Vince Rocco, or my website, thinkvince.com. And Eleanor Roosevelt always said, in life, if life were predictable, it would cease to be life and be without flavor. And from all of us here at Talking New York Real Estate and the More Network, to all of you all around the world, thanks for spending a part of your day with us. I am grateful, and I will see you next time. Goodbye, everybody.